Sure. So I'll just give a short introduction about you,
Yeah.
and then we can start with the Q&A.
Sure.
So the way the format works is we have the core team of DI who are the moderators who are currently on stage with you, and after so we begin with us asking you a few questions. I'll start with the initial few, and then the other mods can chime in.
Yeah.
And then, time permitting, we open it up to the audience, and then the audience will come one by one and ask you their questions.
Okay. So I have one request, since you know that
Yeah.
I'm calling. This call is from US, so I need to have a hard stop at 12:45 because I have to meet someone.
12:45 p.m.
Sorry.
Like,
Yeah, but then what is called 10 9 10:15 p.m.
10:15 p.m. So we've got an hour and 15 minutes.
Yes.
Okay, cool. So
Yeah.
let's try and cover everything that Utkarsh has sent me till
It
that point.
is. Yeah. Okay. Because it is 11:35 now. That's fine. 11:35 a.m. now. Okay, fine.
Okay.
Yeah. Let's start over.
So
First of all,
so the
thank you for actually asking me to come over, and it is pleasure to actually join back DIA because I am associated with DIA for a long time now.
Yeah, Utkarsh was telling me that you've been a part of DIA longer than I
I
have.
think I have almost the first few ones who started that DIA, and then I think something or the other happened that I started moving here and there. So anyway, come to the basics. Yeah, thank you everybody for calling me. Good evening, good morning, good afternoon, wherever you are.
So, for those of you who don't know Aveek is the founder of Aveeksat Investment Advisors. He's been an investor in the Indian market for the last 20 years. He's also got corporate experience of 23 years, having worked in L&T, Usha Martin, and other companies. He's got in his investing style exposure to large and medium-sized companies in their growth phases, and having worked in similar companies has given him an insight into how strategic, operational, and executional challenges that companies face, and how to overcome those. Another really interesting fact for you guys to know is that he was the first CEO of Dakshina Foundation, the one that's founded by Monish Pabrai. It's the same one that I just recently put out the tweet where Warren Buffett had congratulated Monish Pabrai on the quality of the annual report. So very rich, very rich legacy. Aveek has also done his graduation in honors with physics in from Calcutta University, an MBA from IMT Ghaziabad, and two short equity investment certificate courses from Indian School of Business Hyderabad and London School of Business. So Avi, like he mentioned, was actually one of the earliest supporters in DIA and was a speaker in a lot of the in-person meets. So a lot longer than most of us in this room. So Avik, again, thank you for accepting our invite and being here today. So to start the conversation a little bit, could you tell us, what are some of the sectors that you invest in? Because I'm assuming that you're not spread across everything. So what are the sectors that you choose to invest in, and how do you select those sectors?
Okay, so first few clarifications. Presently, I have no association with Dakshana Foundation, and that association has been snapped almost 12 years back for different reasons. And secondly is that I don't want to be classified as any type of investor, though you haven't done it, but I just wanted to make it clear because I try to be as much flexible as possible because my main intention is to generate consistent return for my client portfolio and for our own portfolios. And having said that, so I am actually sector agnostic investor. So I try to first identify which sectors have the potential in the short to medium term, and then start looking into these companies. And that particular understanding of a sector is basically on two factors. I actually, unlike many uh, uh, investors, I also look into the macro factors quite seriously. And though I don't take decision based on macro, but I keep the macro factors in my background. Actually, what is happening around the world, how India is placed, and I can discuss quite a bit about why I feel macro is important for a country like India, unlike the investors from whom you listen or read about, who are basically US based. And having said that, presently I am invested in some of the auto component sector, some of the chemical sectors. I have invested in very few quality financial NBFCs, but very small allocations there. And I think it is spread across. So I just look into the companies rather than a sector. But specifically, if you ask me, I am now invested in auto ancillaries, IT. Hello,
Yeah,
Yes, yes, Aveek.
is it clear?
Yeah, yeah.
much better.
Yeah. Yeah, okay. Should I repeat from the beginning that what I said?
Maybe
Yes,
briefly
yes, please.
summarize it.
Yeah. So, but first of all, I just wanted to tell that thanks everybody, and good evening, good afternoon, and good morning wherever you are. And one clarification was that I am not associated with Dakshana for last almost 12 plus years. I started and worked for almost 1.5 years and then left it. Secondly, I'm not really a particular type of investor. I really want to see, my objective is first one is that consistently generate return for our investors who have trusted us with their hard-earned money. Try to be as prudent as possible with the capital allocation within the portfolio, and we at some time stay in cash rather than keeping or always remain invested. Having said that, I think the question was that which all sectors I'm looking into. Primarily, the sectors where our present portfolio is distributed is one, IT and IT products; two, auto ancillaries; three, specialty chemicals; and then smaller allocation on company specific areas in sectors like banking, in some companies which are specifically maybe unique, or maybe a kind of opportunity we find, that so that kind of opportunistic bets are there in few companies. So, and we generally don't invest in more than 20-25 stocks in a portfolio of up to say 2 crore or 3 crore kind of a size. And when the portfolio size grows up, we always try to see that our portfolio concentration is not very high. Yeah, we are not a high conviction investors that invest 20% portfolio in one stock.
Makes sense. So you spoke a little bit about your background in macro and taking macro a little bit seriously.
Okay, yeah.
So and since you also happen to have chemicals as a meaningful allocation in your portfolio, how do you look at inflation, the way it's playing out right now? And its impact on the chemical sector, but also on any other sector that you would want to elaborate on.
Sure, sure. Yeah, I think I talked about inflation. I missed it while I made the repetition. I look into the macro, unlike. Can I improve the audio quality? Hello.
Yeah, Vikji, it's become slightly softer than it was like the last time you spoke.
Okay. So is it better? Is it
Yeah,
better now?
better now. Yeah.
Okay. So now coming back straight to the point of the macro, I think the inflation scenario in India and inflation scenario in the world, like in US, are two different kind of phenomena which are playing out as far as our reading is concerned. In US, it is both a high demand and there is supply constraints, which is creating a inflation situation which may be stickier than what is presently in India. Secondly, Indian situation, the demand side is not very high, and the biggest measure of that is Number one, the credit pickup is not very high as yet. It is only credit growth is only about 8% in Indian market, and it is consistently low for many years. And before even COVID, our economy has really weakened. The growth has weakened. So the demand side of the inflation part may not play very severely as it is being played in United States. And supply side disruptions, which are actually associated with two, three things. One is the COVID, one is the Chinese, too much of demand in the US market for product and services, which is choking the supply chain across the globe and across the sea, basically. And the China's off and on closing and opening of the economy, which is actually disturbing the global trade channels. And having said that, that is affecting India, but that effect will gradually go down as the time goes by. And another thing which has come right now is oil. Oil is related to these present tensions, which we all know what's happening in Ukraine, Russia. Um, but the impact of the oil on Indian economy will not be as severe as it was, say, 8, 9 years back for two, three reasons. If you see in earlier time, the oil import bill was 8% of India's GDP. Now, since in spite of a slow growth, the GDP has increased and our local demand has not increased that much. So as on today, the oil as a percentage of import is only about 4%. It's as a percentage of GDP, it is only about 4% compared to 8% earlier. And even though absolute term it has gone up, but the effect has substantially reduced. Number one. Number two part is that there was a current account deficit at that point of time because oil was the largest import bill. But now currently our IT sector, the IT export has exceeded our import requirement of crude. So that has actually adjusted the current account balance concerns which we had earlier, and that memory we carry now that whenever the oil price goes very high, the inflation will sustain for a very long time. Yes, inflation will be there, but we still feel, as per the data which are coming from different sources, that this inflation is less sticky and more transitory in nature as compared to the inflation which is happening in the developed world. Am I clear in this part?
Yeah,
Yeah,
absolutely.
absolutely. Okay. So having said that, we feel that in the specialty chemical sector, the investments will be having some problem in the short term. Maybe this year, this quarter and next quarter, in Q4 and Q1 23, there will be having certain problems in kind of margins and things like that. But the long-term story remains constant. Another thing I think I wish to tell on this particular part, that we many a times see that the margin contraction, but the margin contraction may not be a right kind of metrics to look into while you are looking into this kind of transitory phenomena, because suppose a company which enjoys 50% gross margin and their raw material price have gone up by 5 rupees and they have passed on that 5 rupees increase to the customer. So they used to get 50%, but now 105 rupees and 55 rupees has become the gross margin. So gross margin will optically reduce, but they haven't really affected their particular earning capacity. So you need to see that whether the absolute margin is going up year on year, and what is the kind of gross margin, gross contribution which is there in this company. Yes, a specialty company should ideally have at least, uh, we expect that 30, 40, 50% kind of a gross margin, so that they are doing something on in-house to actually keep their margins not that much affected by the global inflation and things. But obviously, this shipping delays, the ability of customers to actually absorb the price in a timely manner,
and these kind of things will affect them for quarters. Like say some customers must say that okay, I can absorb this price, but I cannot pay now. I will pay 2-3 quarters down the line, because it all depends on what kind of product they're selling. If they're selling a product which is absolutely essential, and when the end customer, who is a buyer, who is also having a good amount of margin and traction, then this kind of effects get minimized. It's a kind of a whipsaw effect. If you turn a whip, on the first level, the kind of wave it is there on the first level, as you go towards the end of the whip, the effect is not that pronounced. So that same kind of phenomena sometimes works in this kind of supply side effects. So I'm okay with these investments. I'm okay with a non-performance or muted performance or sometimes negative performance on some of these companies for 1-2 quarters. But I don't think that this has really enough reasons. There are enough reasons to really sell it to improve our client returns.
Makes sense. Now, if I had to ask, can you mute it when I ask? One second. Yeah. So my next question is then about auto ancillaries. Since you mentioned that is another big sector that you have invested in, how do you see this auto landscape right now? How do you see uh, the BS6 transition, the transition to flex fuel and EV?
Okay, so this is a good question actually. So if you see the auto sector has gone through a series of negative events, starting from one, GST implementation, second, ILFS crisis, third, BS6 implementation, fourth, COVID crisis, fifth, not enough employment generation in the country which can create a new set of customers. So the auto sector has a perfect alignment of bad events uh, happened side by side over a long period of time, almost for last 7-8 years. If you see the growth rate, almost whatever number of autos sold in 2015 and the number of automotive sold in 2021 is almost same. And this may have happened after a long time in India, because India generally had a secular growth story. Now, all these things are external events to the auto companies. Number one. Number two is that, except one part, that is the lack of employment creation in this country, most other factors are transitory in nature. And employment creation lack has also been a little bit blunted this year by the huge increase in salary and huge increase in employment in at least one sector, which is IT. And IT is the main force which has created our middle class. I think if you see our middle class creation, the main engine which has created the middle class was the IT sector. All other sectors, including our pharma and manufacturing, have created the other base, but that base is not growing at a pace which we wished for. Now, having said that, I have not invested in auto companies, automotive companies. I'm not invested in a Maruti or a Ashok Leyland or something like that. I am invested in auto components, who are basically having an international market with a tie-up with either OEMs or tier one suppliers in the overseas market. And now the overseas market demand is going to pick up maybe faster than the demand which can happen in India. And this EV landscape will create a new set of supply chains where India can fit in, may not be on the high tech areas, but areas where Say a kind of standardized component requirement has been established, like say some kind of an aluminum casting, to give an example. So aluminum casting is a big area where say maybe Indian players can uh, make a dent, say many kind of battery housing components. So we will be component suppliers rather than a kind of the applications, and also we will be a big supplier of the softwares. Like company like LTTS or KPIT and things like the companies, if you can go through their presentations and all. I'm not making an investment suggestions, but I am just telling that you can get some idea actually how they are actually plugging themselves into the EV ecosystem. And the EV will be reality. Presently, even though it's having a slow start, but at the same time, you will see that it is taking shape very quickly, because the climate change is real, the global weather change is real, the kind of Paris Accord is real, so these are going to happen. So I'm okay with an investments, and also the automotive, the IC will remain even after 10-year, 15-year, 20-year down the line. 60% cars, yeah, at least in India, will be sold, which is some kind of IC engine, mostly hybrid, mostly with be having a multiple kind of fuel independent transmission systems, might be having gas, but the electric four-wheeler is not going to come anytime soon in countries like India, because number one, we don't have the infrastructure. Number two, we cannot have generate that kind of power without further again increasing the pollution level, because that power cannot be generated by wind and renewables, right? So either you need a nuclear power or need a coal-based power and things like that. So the demands will be there for a long time. It is that, and we have invested all these things in last 6-8 months, and when we find that the sector is really going through a phase which is going to prolong for some more time, and so that we can buy it. So, and I'm positive both about the automotive sector globally and also about the automotive component segment for Indian companies for a long time to come.
Cool. Do you, do you want to elaborate a little bit on the fuel part of it, because you spoke about combustion engines and other forms of fuel coming in. So just wanted to get a little bit of your sense as to the transport minister, Mr. Gadkari, has spoken and is very strongly pushing ethanol going forward. Even the notion of E100, being a fuel source. So, do you see these things, playing out? And if yes, then what percentage of that, 60% or 40% of combustion engines do you feel will be run through crude, and what part of it do you think will be alternative fuels?
Look, first of all, I'm not very positive on this ethanol story, because I think Indian this cane sector, where this particular craze is going on right now, is something which I don't really have a full faith on. I'm not saying that those who have invested have made a mistake or something like that, but we have not made a mistake, and we generally don't invest in commodity sectors. Now, my concern about this is more environmental than actually whether ethanol blend is good, bad, because we are a deficient country as far as the fresh water is concerned. I don't know if most of you know about it, that India has 60% of the world, 16% of the world population, but only have 4% reserve of fresh water. This is one of the biggest concern for us as far as our environment and climate change is concerned. Now we are in incentivizing the farmers in the cane sector to produce more in areas where the groundwater can be used in a much better way by producing some alternative crops. And I think that either sooner or later the global community will actually come back on India on this issue, that when we incentivize so much of cane production, which cane is absolutely, that cane is very heavily dependent on water. And so this particular part, I think 10%, 15%, why government is doing it? Because government wants to insulate the companies as well as the farmers, rightly so, from the vagaries of the cane production cycles globally, which affects the prices, which affect their payments, which affect this FRM, this fair and remunerative measures or something. What is the name of that? I think one is the SAP and one is that state administered price or something like that. So all this kind of mess which has been created around this ecosystem of farmers' payment, procurements, then government coming out and trying to give subsidies or incentives to clear out the debts, it becomes an election issue. So get out of this. I think the ethanol is okay, but I do not think ethanol is a major kind of story which will sustain over a long period of time. I may be wrong. I may read the situation pretty wrongly, but that is our view.
No, Avik,
No, we
check.
check. I
I
completely
completely
agree
agree
with
with you.
Yeah. Okay. Thank you.
you.
No, I may be wrong in our
No,
chat.
no.
No.
There's actually a
There's
lot of
actually a
echo.
lot of
Can you?
echo.
1 second. Yeah. So I completely agree with you as far as um, the sugar part of this goes, because the sugar being like 55% of the sourcing of ethanol, and it being extremely bad for our water table health and for the water situation in India. But we also have the ability to source ethanol from broken grains, and that is something that we tend to have an abundance of. And also our agricultural yield right now for rice and allied products is also quite low, so the yield for that could potentially go up with better farming practice, being able to produce better feedstock for ethanol. Of course, we would have to wean ourselves off the sugar supply that we have right now, but do you see that if that happens, I mean, you may know a little bit more about rice and how that would work. Shouldn't that be a lot less harmful to the environment?
Can you explain the question a little bit better way, because I have not fully grasped your question.
Sure. So, you spoke about, ethanol that was derived from sugar. Ethanol comes from two primary fuel sources, feedstock. One is the sugar cane, and the second one is through broken grain, which is rice and other allied products like rice. So the point that you raised about sugar is one that, in fact, I've raised in this community multiple times over, that it's completely unsustainable. But assuming that we are able to wean ourselves off the sugar, and we can source all our ethanol from broken grain or other sort of agricultural waste product, would not then ethanol become a much larger opportunity?
Yes, possibly so. But you get one point clear, that this broken rice and things like that have many multiple uses. One is that in waste heat recovery plants of many companies, this kind of agricultural wastes are used, and more technology is being developed to use it as an alternative fuel to coal for generating heat. And even yes, it can also be used for an alternative fuel like ethanol. But I would like to see the global practices. Like I don't find, at least I do not know, maybe my research on this is limited, but I do not know of any country which has really made a very substantial success beyond a certain point. Because I also talked to a few automobile experts, and they said that beyond a point you cannot really mix ethanol, whatever form it may be, and without reducing the either the life of the car, or the efficiency of the car, or things like that. So, to be very honest with these questions, nuances are concerned, I am not very familiar with how to really answer this question, which can satisfy a discerning audience.
Sure, sure. Okay, so to move on, then let's talk a little bit about IT, the IT boom that has happened in India, and we're seeing not only large cap IT but also mid cap IT really take off. So, would love to hear your views both on large cap IT, which is still growing at more moderate pace, the valuations around IT, and especially when you talk about mid cap IT services and mid cap engineering and design, the likes of LTTS, Tata Elxsi, and all. They're all fantastic companies, but at some point or some valuation, they may not make sense. So, would love to hear a little bit of your perspective on that.
Okay, I think before answering these questions, I need to tell a few things. That to us, most important thing is to see that what our clients are looking for from their portfolio. Our portfolio construction part is more important than stock selection part. I think what we mastered over a period of time, if you say about one thing, is that how to construct a portfolio which can meet the client's requirement, and also see that it is growing as per the kind of portfolio and the client mandate we have. Why I said this will be clear when I answer these IT related questions. Now, suppose we have a client with a family office who wants a kind of a return which is net of tax, net of fees, is about say 12-13% consistently over the years. So there we are, our proportion in portfolio construction for an IT service company is much higher compared to a client which is coming with 50 lakh rupees, maybe younger in age, and having a goal of making say 20% return, or expects to have a 20% return in their portfolio. So we cannot really guarantee anything, but we try to see that our portfolio is positioned in a manner which can capture the uh, uh, return expectations of the client, as well as not become absolutely berserk in our risk taking. Having said that, now coming to this answer, because that will be clearer, because we are having some kind of IT companies like say Infosys and Coforge in some of our clients who are larger. We know that these companies will not show much volatility. So its volatility will be much lesser, and obviously it will give growth if you hold on at may not be at a rate of 15%, but at least at a rate of 10-12%. So in my portfolio, at least 40-50% of the area I can ensure that I'm getting say 10-12% return yearly basis. Then I look into the rest 50% of the portfolio and see that how I can construct that so that I can generate 1% alpha over the other 50% of the portfolio, 2% alpha over the other 50% portfolio, which I have kept in a steady area. Now, why I have put this kind of a background in telling this is because for us, this portfolio selection makes our decision on whether we invest in IT service, IT products, smaller companies, bigger companies, and things like that. Now, coming back to the specific questions, yes, their valuations is high, but they are in a structurally long-term uptrend, or long-term, I think, positive factors favoring them because of various kind of issues. Number one is all we know that during the COVID, they substantially changed the landscape. Second is that the kind of cyber crime, cyber hacking, or all these things, global warfare on the cyber world has started to make the security system more robust. Upgradation of the security systems, maintenance of the security and maintenance of the services become much more critical than a regular kind of an exercise. So these kind of things have first of all developed the criticality of the business to a notch which if it was earlier it was 5, then it has become now 7. Earlier it was 6, it has become now 9. About the criticality of IT in the overall business environment. Number two is that as we all know that this remote working and all these things. Number three is that the talent requirement of this kind of jobs have also gone up, and so there is a dearth of talent around the world to meet the kind of demand and the kind of numbers required. Here, I think nobody can beat India, because as when the numbers come in, we can beat anybody hollow. So these things have really put us in a big long-term trend, which will continue. Now, whether Infosys can grow or Infosys can take the place, I am not very confident about. The very old companies can change themselves very substantially to take the newer areas of the business. But at the same time, their base business will keep growing, because the base business requirements will have the requirements to remain for, say, many years to come. Now, the predictability gives the valuation, right? So if you predict that you can grow for 10% for next 20 years, vis-a-vis if you grow a company can grow 50% for next 1 year, the valuation of the previous company will be much higher compared to the one who will be growing 50% for 1 year, but we have no idea what will happen 2 years down the line. It's same like, say, your ethanol story, or say your grain-based ethanol story versus an IT company. Okay, so maybe for 1 or 2 years it can do some kind of better returns, but you cannot build a portfolio around it. So when you build a portfolio around a good size, so what are the options you have? So there is also another part comes in, the lack of options in Indian market to remain in that kind of long term stories, where customer requirements are modest. Want to protect the capital without facing much volatility, sleep happily, and earn more than the market rate. So this other options of return. Is it clear?
Yeah.
Yeah.
Just a follow up on that. I understand the part about the growth, but I wanted to get a little bit of your sense again on the margin side of things, both for mature IT companies and for mid cap IT, because a lot of these businesses are sitting at lifetime high margins, and lifetime high multiples as well, and a lot of commentary seems to be surrounding this, which is that margins can only go down from here, um, and therefore multiples will also only go down from here. So just wanted to get your view both on, since you've spoken a little bit about valuation in the larger side of things, if you could touch upon the valuations in the mid cap space, even if it's not necessarily something that you might put in your portfolio, and also margins for both these spaces, please.
Yes, I think I'm fully in agreement that the margin are at the record level, and also the valuation is also pretty high. But the valuation is high, not more than margin. If you see, I think the visibility of earning over a very long period of time, and the surety of that earnings steadiness is the two factors which has elevated the valuations. And third factor which has played is again the FIs and domestic institutions. If you see their portfolios, it is mostly consist of all the mutual fund portfolios and all. If you see that, it is mostly consist of same kind of stocks. So maybe the allocations, there may be differences. So the demand for this kind of stocks has created a kind of higher valuation. Yes, and that is a concern. We are keeping a track of this. We don't think that margin can really go up from here, and also the companies, their customers will start squeezing them. But what I feel, at least for 1-2 years, this margin is sustainable because the number of people available with the right kind of skill set is very, very low. And IT sector has an ability to a large extent to pass on these prices because they are almost a mission critical things they do for the clients. So, but I fully in agreement. I'm fully in agreement, and I'm fully keeping a track of the things that how the margin trajectory pans out. And I do not think, even in the next quarter, I do not think the companies will come out with the good results because the kind of salary hike which they have to pay, they have not been able to pass on that to the clients as yet. That is what I hear in US. From different IT companies and from even from Indian company counterparts who are sitting here. So yes, on a short term, long term, long IT, large cap IT companies will have a kind of a concern. But on a mid cap sector, I think there are companies where we are invested actually. We are making the products, and sometimes I think we don't value these companies to the extent it is valued elsewhere in the world. Simply because in some companies we have some promoter concern, they had some kind of issues earlier, and in some businesses we don't fully understand. There are some companies in the startup space we fully don't, not startup, sorry, what should I say, newly listed companies where we don't fully understand and appreciate the business potential. So here I think there are some companies where small investments are warranted because their businesses are pretty unique. Like say suppose some company who makes a kind of product, who actually are these kind of Zomatos and others are using when you are seeing that how far is your driver from your home, or how far is that particular when that person is arriving, and this kind of things. If a company does that kind of things, and that sits on that particular application for years and years together, and this can only grow as the digital ecosystem grows. Or say a company which is making a kind of a software which is making a cloud based systems making much more robust the existing systems of the bank, and making much more flexible to add new products, or that kind of areas. I think the way the valuation, the way the companies are looked into in US market or elsewhere, and how it is looked into India are very different. So in those areas, small allocations, again for us the allocation is everything. So if I lose, I can lose. If I make 2-3% allocation, and if the stock goes down by 25%, then I lose only whatever 0.75% on the portfolio. So portfolio allocation is everything for us. So when I'm talking, you don't think that I'm talking about investing in this company without looking into a specific portfolio. For us, this portfolio construction is more important. Having said that, yes, there are opportunities where I find that these investments in the mid cap sector has got potential to give returns over a period of time, in spite of some of the sectors, some of the stocks looking optically.
Great. So just one last question from my side, and then I'll give it to the mods, and then maybe the audience as well. So we've got, I think, 20 minutes more. So the last question from me is about management. Utkarsh tells me that you spend a lot of time interacting with, different managements of different companies. So just wanted to get your sense, what are some of the things that a retail investor or a average investor can do to be able to figure out whether a company's management is good, both in terms of capital allocation and integrity, but also in terms of vision.
Okay, so I think your three parts is a question which needs a lot of time to answer, and I think we can extend our meeting by 5 more minutes beyond the time which I already said, because for me actually you lost 5 minutes, so I just want to compensate on that if required. Now coming back to this issue of three, yes, this is a very very important part for us, and I am interacting with promoters for over 25 years now, and I try to attend as many AGMs as possible, try to attend as many calls, try to meet them one on one if possible or in a group. So I there are few things actually, the few things which are tangible and few things which are intangible. So I think over a period of time, with experience, I think that I like to see. I may be right or wrong. That is a different thing. I may be biased, and that bias has also lost me money. Lost me money means lost me opportunity. So I try to see that how a promoter comes when they're interacting with the investors. What are the body language? How fair are their disclosures? Whether they're trying to evade, or they are trying to sugarcoat, or they are trying to give a very rosy picture and things like that. These are softer aspects. This cannot be really documented, or put it in a very objective manner. Now coming to this issue of how I judge the promoters' intentions and activities from the very objective measures which anybody can use is primarily the hard work of going through the annual report, how their disclosure standards are, how who are their auditors, who sits in their remuneration committee, who sits in their audit committee, whether the main promoter himself sits in the remuneration committee and audit committee. These are the pointers. I'm not saying this will give you a kind of a one size fits all and one kind of magic bullet which can give you the answer, but I am saying these kind of small points. Secretarial audit report, you see that what are the observations. If you see that in the auditor's report, when you are reading an auditor's report, you see a major thing which I sometimes miss, or the retail investors miss, is that auditors sometimes say, okay, this company may be 5,000 crore, but we have audited 2,000 crore worth of businesses with 500 crore worth of assets. Other part of this audit has been done by other auditors, whose audit has been certified by the management and given back to us. So now in that kind of situations, you raise the question, that means the auditor is not certifying the entire report, but actually certifying the part he is auditing, and he said that, okay, I believe, Baba, what has been given to me, I trust it, and VLO, whatever I have. So he is basically absolving himself from if there is anything wrong in that particular thing. If that kind of thing happens year after year, this put a red flag. If it couples with the factor that the company's loan is increasing, receivable is increasing, cash flows are going down, or growth is delayed, the business, either they are not communicating anything, or they are communicating something which doesn't make a logical sense to investors, or they are saying that every time they are giving excuses which are external to their business, that for this we haven't not been able to do it, for that we have not been able to do it. Okay, so those kind of things actually create a kind of impressions in us. Capital allocation is something which actually is decided based on what is the kind of base business possibilities there, right? Suppose the base business is really a cash requiring machine, then the capital allocation becomes easier for a company, because he knows that, okay, I put more capacity, I will get more, I will earn more. If I put more capacity, I'll earn more. Or if I just extend into the particular chemical sector, I make this kind of chemical, I will make another kind of chemical. Okay, so for them actually the capital allocation becomes much more easier, because and that is one of the reasons why I feel that the specialty chemical sector has a long runway, because the capital allocation can also be like, say, if you see again, without recommending the company, we say Aarti Industries, they are, or Divi's Laboratories, they are making a capital allocation after allocation, because they are going into some adjacent sectors one after the other. Capital allocations becomes much more difficult for a company which has got a large upfront capital requirement. Now, there the question sometimes is that the management, we have to have the faith on the management. Like Tata have made a very long capital allocation in buying Coras. Now, we tell that Tatas were unethical, or they were stupid, or they may be just they were wrong. pretty wrong in that particular capital allocation, and that have pulled down this. All these kind of investments in Tatas have pulled down their businesses, like say Coras to all these things, Jaguar and whatever. They have a fancy of purchasing things here and there, but they are not corrupt. They may be incapable of doing right kind of decision. But there are certain kind of investors who make capital allocation which are downright corrupt. A small company which is buying a big company in outside India and who are unknown promoters in India is always a red flag. Now you see their management. If you see that they have purchased a company in some Italy or some Germany or somewhere, and their group CFO is sitting in Delhi, and who is just a chartered accountant who doesn't even have the background of understanding the foreign accounting system. Is a red flag for us. Now, right or wrong, that is a different thing. That is how we look into it. Right, because I want to see that that company which is investing abroad has the capacity and the bandwidth available within the company to control that company. You take any company who has big purchase outside, sitting in India, thinking that okay, that asset was available cheap and we have purchased. 9 out of 10 cases they have foundered. If and I can name company after company on this issue. So these are the areas which I avoid, because I think that most of the time the management does not know what are the capacities. They think that buying an asset itself is enough to run that company, which is not. Especially in Europe and US and things like that, where the culture, working culture and people's culture, people's mentality towards their job are very different. And but understanding management on an objective way, the hard work is necessary. Listen to con call, read annual reports, read presentations, and do whatever you can to know what management is doing, and listen to their interviews in different channels and things like that. Keep an alert on whenever management speaks somewhere. Try to understand their lifestyle and their salaries, because somebody earns a very poor salary is a big question mark for us. Somebody draws a very high salary is not that question mark for us if I see that the company is drawing very low salary. Okay. So these kind of various issues actually. So many kind of things. There is nothing absolutely objective out here, except the fact that yes, reading those annual reports is very objective measure.
Thank you.
Thank you, Aveek.
Other mods?
Other mods?
Hi, Aveek. How are you? Aveek, I think you mentioned that you do not invest in cyclicals or the commodities actually. You didn't invest in commodities, and I think you also mentioned that you have a very small allocation towards banking and NBFCs. So I just wanted to understand why very less allocation towards banking and NBFCs.
Okay. So now you see that there are 3-4 issues. Now we see one discussion in India that you see the corporates have deleveraged their balance sheets, right? Am I right on this? So corporate deleveraging of balance sheet is a big factor for India's next phase of growth or capital cycle recovery. That is what we tell. Right. Number one, and that is correct also. Number two is that we also talk about the SME sector and MSME sector is not doing well, and that is why the demand is not picking up, and also the job creation at the lower end is also languishing for years together. Right. So if both the factors are right, then the one leg which is taking this NBFC sectors up is the retail credit. Now, retail credit has a limit to growth, because if you see, Indian savings rate was 34% about 10 years back. Now, the Indian savings rate has come down to 28% as a part of GDP. So, the retail's ability So retail has actually funded many of their purchases and things not from their saving but from their taking credit. Now this credit also has a limit to grow, and entire NBFC sectors, there are pockets which can grow, but I don't think that there is a huge trigger available in front where there will be a big growth coming into the banking sectors and to the sectors which are focused to the corporate lending, because corporates actually also have a bond market now. Number one. Number two is that if a company is good, they are having a private equity market who can also provide it a secured uh, what is called a secured a debenture or something like that. So preference shares and non-convertible preference shares. So the avenues of getting the kind of what should I say, finance has increased manifold over a period of time. So how India is projecting to grow at 7-8%, because India is projecting to grow 7-8% because we feel that there will be huge amount of foreign capital coming in. Otherwise, our internal ability to grow has substantially reduced because our domestic savings rate have come down. Because if you see, if I just allowed to give a little bit about these issues for 2 minutes, that the domestic savings rate divided by incremental capital output ratio gives basically the uh, GDP growth rate if you assume that there is no foreign investments coming into the market. So if the ICOR is about 5 or 6, so India can maximum grow at 4.5, 5.5%. But that gap in the growth, the capital needed can be brought in from abroad, and the money is there to plug that gap. Now, if that money is also being taken into consideration, then where is the opportunity for local banks who actually has a high cost of funding for the deposits they take, where they will lend? They will lend only when the economy starts picking up, when the SME sector starts picking up. And if the SME sector and MSME sector starts picking up, we will find enough indications. And then if we will invest there, it is not that we don't want to invest there. We need to see the trigger. So the trigger I am not seeing right now. Where the trigger I can see is that, and also there is another issue that fintech is also going to affect their retail lending, because most of the fintechs, if you see that, they are basically trying to intermediate between the banks and the financial sectors and the end customers or end MSME or SMEs. So if that kind of sectors also take their pound of flesh from their returns, and without really increasing the cost for the end customer, then banking sector margin also will be having a margin effect. Now, having all this said, if the SME sector, the demand for credit picks up, which is 8%, is very, very low, because 8% credit growth means that economy cannot grow more than 4%, because generally the intensity of credit growth is 2x of the GDP growth. It is historically so. Now, even if it goes down to 1.5% because of other form of capital is available, then also you need credit growth to grow up to 12, 13, 14% minimum. So unless that comes in, unless the banks become a little bit less hesitant to lend, because nowadays with our kind of new banking setups, now the public sector banks are afraid to lend because they don't know that when the CBI comes, if they retire after that, after 10 years after their retirement, if the CBI starts attacking them, like what happened in the case of Mr. Prateep Chaudhary, that he has given some loans sometime 10 years back, and for that he has been hounded. So the banks will be hesitant to lend unless they have got a full surety about the collaterals. And you know that it is sometimes not possible for smaller kind of companies to give that kind of supports and backings for their credit. So having said that, we will find enough indications before we increase our allocation. We are not saying that we are never invest.
So, Avijji, so in the short run, you think it's not a good time to invest in banking, but in a longer run, when credit growth picks up and India's GDP growth rate increases, we can see a good credit offtake from banking sector. That's the take I'm taking from your comment.
Yeah, a little bit of change. After GDP growth picks up, if you take, I think it will be too late. If you think that the incremental GDP is growing up primarily from the sector of MSME and SME's contribution towards the GDP, if you see that breakup, then only you should make investment. If you think that GDP has already grown at say 7-8%, then I think you will miss the bus.
And one more thing, Avijji, when you say bond market and other avenues are available and hence banking pie will reduce for the credit growth, wouldn't banking be participating in those avenues? Also, I think the cost of funding from the banks, even if somebody goes out and tries to get a loan from abroad, they have to do the currency hedging and all and interest rate hedging and all. So eventually the cost usually comes almost similar to what Indian banks are offering. So I feel the competitive advantage doesn't bodes well for foreign banks.
No, you are absolutely right, and I think you have. I think either I have not been able to communicate rightly, or you have misunderstood me. What I never said that the Indian company, who is SME or MSME, will go to foreign and start raising money in overseas market. All I tried to say is that alternative avenues like private equity or the venture capital funds have started to invest into a set of companies which earlier were neither getting a finance nor bankable. Okay, either they were not bankable or they were getting finance at a very high rate of cost. Those kind of things. I never talked about the foreign currency money raising. Foreign currency money raising is reserved only for very, very large companies. It is not applicable to the smaller companies. Smaller companies, when you're talking about an, obviously the banks have a much cheaper source, but banks need much more security, right? So that security sometimes becomes an issue, and much more certainty about them. But when the working capital requirement, banks were originally meant to provide working capital. Now working capital requirement is primary reason for banks to exist, and working capital requirement will come with the economic recovery, because economic recovery will make it increase sales, increase receivable, increase payables, and the banking activity, credit lines will grow. So one way you can look into it is basically that when you go to this CRISIL or something, CRISIL or ICRA or something, you see that what kind of total credit enhancement has been done in their banking limits of different kind of smaller companies. So those reports are not easily available, but you can get access if you want to pay money. So from there you can see that, okay, suppose a banking line for a company was 100 crore, they have increased it to 200 crore. What is the reason behind that? So those kind of things can give an indication. So that is not happening at this point of time, if my data are correct. But to make this point very clear, I never said that overseas money or something like that.
All right, Avijji.
All right, Aveek.
If any other mods have any other questions, please go ahead. I have nothing to add.
I think there are no more questions, so we can put it off.
Yeah. So thank you so much, Aveekji, for coming and joining us today. It was a really interesting discussion, and thank you for sharing your perspective on the various sectors that we discussed. Uh, on behalf of DIA, I would want to say thank you, and we really, really look forward to having you again.
Yeah, sure. It'll be my pleasure. Thank you, everybody. Bye.